In the last few weeks, India's biggest banking stocks have been under pressure. HDFC Bank, ICICI Bank, SBI, Axis Bank, Kotak, and right now everyone is asking one question: is this the biggest buying opportunity of 2026 or a trap? Because if you get this wrong, it can cost you years of returns. Today, we are going to break this down using real data, institutional research, and in depth analysis. So, if you've already invested in banking stocks or you're planning to invest, the next 10 minutes will give you complete clarity. Here's what's confusing most investors. On one side, stocks price are falling. On the other side, banks are reporting strong profits. So, how can both be true? How can a sector that is doing well fundamentally still see stock prices going down? This is exactly where most investors go wrong. They either panic and sell or they blindly buy. And both decisions, without understanding the full picture, can lead to losses. So, first, let's talk about banking stocks. They have been beaten down recently, and this decline is not random. There are clear fundamental reasons behind the correction. Or reason one, the West Asia war. On the 28th of February 2026, war broke out in West Asia.
Between Iran and the US have escalated sharply in the Strait of Hormuz yet again. In the latest, a US destroyer fired and seized an Iranian flagged cargo warship in the Gulf of Oman.
Oil prices spiked. India imports over 80% of its crude oil. Higher oil means higher inflation. Higher inflation means the RBI cannot cut rates as aggressively, and banking stocks hate that scenario. Reason 2, the RBI's forex cap. On the 30th of March 2026, the RBI imposed a $100 million net rupee exposure limit on banks. Bank Nifty fell 3.82% in a single day. That's nearly 2,000 points gone. Reason 3, FII selling. Foreign investors pulled out rupees 6 lakh crore from Indian markets between September 2024 and August 2025. When FIIs sell, they sell the biggest, most liquid stocks first. And guess what those are? Banking stocks. Reason 4, net interest margin pressure. The RBI cut interest rates by 125 basis points since February 2025. Repo rate is now at 5.5%. That compresses the spread banks earn between lending and deposits. Margins came under pressure. Now, all of this is real. All of this is valid. But none of this has changed the quality of these businesses. Now, I want you to pay very close attention to this section, because these 5 numbers tell a story that most retail investors have never seen. Number 1, bad loans officially called gross NPA ratio, 2.1%. That is the lowest level in 20 years. In 2018, it was 11.2%. Think about what that means. In 7 years, Indian banks cleaned up their entire bad loan crisis. The system went from broken to pristine. Number 2, net NPA, the real loss after provision, 0.5%. Lowest in 2 decades. Banks have already set aside money for bad loans. The downside is protected. Number 3, return on equity 14.09%, best in 10 years. In 2018, it was minus 2.74%. Negative. Banks were losing money for shareholders. Today, they're generating 14% returns on your capital. Number 4, total net profit of all Indian banks in FY25, rupee 4.1 lakh crore, all-time record, up from 3.5 lakh crore the year before. Number 5, India's credit to GDP ratio 93%. That sounds high, but compare it to global peers. USA 220%, China 180%, South Korea 160%. India has barely scratched the surface of its credit potential. So let me ask you a question. Does a sector with 20-year low bad loans, decade high returns, record profits, and massive room to grow, does that sound like a broken sector to you? Or does it sound like a sector on sale? Let's get to the most important question. So, the question I promised to answer at the start, value trap or genuine opportunity? My honest verdict, this is not a value trap. A value trap is when the business is also broken. Here, the business is exceptional. Only the sentiment is broken. Broken sentiment plus exceptional business equals opportunity. That is not a trap. That is the definition of value investing. I want to leave you with one thought. The investors who made the most money in stock market didn't buy when it felt safe. They bought when the headlines were scary. When everyone around them was panicking, they bought exactly when it felt like this. Listen to Rakesh Jhunjhunwala, what he talked about the end of a bull market.
Bull markets die in two reasons. When the upswing in corporate profits ends, and there is extreme participation by people. Even if profits spike very badly and don't repeat themselves, if there is no participation by the public or there is no overcommitment, then markets don't end easily.
Bull markets don't end because one sector falls. They end when the entire market loses strength. Right now, banking is under pressure, but the broader market structure is still intact. The only question left is, what are you going to do with that knowledge? If this video helped you think more clearly about your investment, share it with one friend who needs to hear this right now. Subscribe for more data breakdowns every week. And drop a comment. Are you buying, holding, or waiting? I read every single comment. See you in the next one.